European banks and governments owed their debt in dollars, so the European Central Bank couldn't just create more dollars to bail them out as the Fed had done in the United States. The Fed had been working hard to stop the bleeding, extending the swap lines that flooded Europe with dollars. But there was only so much the swap lines could do.
By 2012, Europe was at risk of entering a doom loop, whereby failed government loans would damage the banks, which in turn would suffer huge losses and drag down growth, making it even harder for the governments to pay off further debt.
As always, this threatened the United States because a massive European downturn would hurt demand for U.S. goods. The second threat, the domestic threat, was even more urgent. The Tea Party movement had effectively neutralized Congress.
The only acceptable public policy plan, in the eyes of Tea Party leaders, was to cut taxes, cut government spending, and reduce government regulation. In the summer of 2011, the Tea Party pushed its crusade into new terrain, threatening to default on the federal government's debt if the Obama administration and the Democratic-controlled Senate did not adopt Tea Party policies. This fight was centered on what was once a routine vote to pay the government's bills, a vote known as raising the debt ceiling. The term was misleading. The vote wasn't to increase overall spending and debt, but just to finance the spending to which the government was already committed. This nuance was meaningless to the Tea Party, which would not vote to pay. Standard & Poor's downgraded U.S. government debt, an asset that was once considered a riskless bet. A debt default loomed for the first time in American history. This catastrophe was only averted when the White House and the Tea Party reached a very strange compromise. Congress agreed to pay its bills, but only if a time bomb was installed in the federal budget. The time bomb was a series of automatic spending cuts that were so draconian and irresponsible that even many Republicans couldn't live with them. The theory was that the insanity of the cuts would force Congress and the White House to agree to a new, better compromise before the date of detonation.
This date, as it happened, was set for January 1, 2013. Bernanke called the looming budget cuts, which totaled about $500 billion, the fiscal cliff. The cuts amounted to about 3 or 4% of all economic growth in the United States. Economists feared such cuts would push the country immediately into recession. In the face of these dangers, Bernanke believed that the Fed needed to have the courage to act. And he was helping ensure that the FOMC had no choice but to act.
In the days after the Jackson Hole speech, public perceptions began to harden that more QE was coming. And the Wall Street traders began to focus their attention on the Fed's next meeting, in September, when they expected this QE to be announced. Before that happened, the measure would need to be passed by the FOMC, preferably with no more than one dissent. Bernanke had used dense economic language to promote QE publicly. Now his team would use the same approach internally, with the FOMC. The Fed's economists were already working on a presentation, steeped in numbers and full of charts, to present at the next meeting. The presentation told a story about QE that was very hopeful, and also almost entirely wrong. On September 12, the members of the FOMC gathered in Washington, D.C., for their regular policy meeting. Bernanke had prepared the ground for another round of quantitative easing, but the scope and shape of the new program were still unclear. Bernanke and Yellen were pushing for an open-ended program.
Early versions of the much-polished Option B called for a QE plan that had no set end date. The open-ended nature of the plan was meant to be a compromise with those who objected to it. The idea was that the Fed could readjust or even end the program if it proved to be unnecessary. There was a sense of inevitability inside the room. Bernanke's speech at Jackson Hole had built up expectations on Wall Street that a new round of quantitative easing would be announced the following day.
But it wasn't enough for the FOMC to vote based on a sense of inevitability. The entire rationale for having the committee was that its members would vote on policies after a dispassionate debate. The meeting opened with a long presentation from two Fed staff economists that seemed designed to settle any doubts about the new round. The study was framed as a scientifically rigorous forecast of what another round of quantitative easing might do, and how long it would last. It used rigorous academic language and was full of precise measurements and graphs. But this presentation, for all its detail, was catastrophically wrong in virtually every important prediction that it made. Revealingly, the grave mistakes all pointed in the same direction. And it was a direction that would help Bernanke push his case. The presentation was written by Seth Carpenter and Michelle Ezer. Carpenter presented their findings to the FOMC. He was a relatively young economist, but his PhD from Princeton and years of working as a Fed researcher gave him a firm command of complex issues.
His demeanor and his vocabulary exuded expertise and cool competence. The jargon he employed was almost numbingly intimidating, as when he pointed out, at the beginning of his presentation, that the staff analysis starts from a term structure model that embeds Treasury and MBS supply factors as determinants of the yield curve. In spite of the jargon, the main points were simple enough. The forecast predicted that short-term interest rates would remain pinned at zero throughout 2013 and 2014, as the new round of QE was rolled out. But, after that, the forecast predicted that the rates would start to climb again, rising until they reached historically normal levels around the year 2017. Things would get fully back to normal by about 2018, when short-term rates would return to roughly 4.5% or higher. This was magical thinking. In reality, the Fed funds rate stayed at 0.4% until the end of 2016. By the middle of 2018, the rate had only risen to less than 2%, or half the rate that was forecast. This same pattern of error held true for other key metrics, like the average rate on a 30-year home loan. This was forecast to drop at first but then rise steadily until 2020, when the rates would be above 6%. In reality, home loan rates rose during 2013 but then stalled out, and fell steadily until 2015, when they hit 3.6%. The rate never hit the 6% that was forecast and was only 3.5% by early 2020. The gravest errors had to do with the Fed's balance sheet, which reflected just how many bonds the Fed would buy and, conversely, how many new dollars it would inject into the financial system.
Carpenter and Ezer focused on the value of the account used by the Fed traders in New York. The Fed predicted that its holdings would expand quickly during 2013 and then level off at around $3.50 trillion after the Fed was done buying bonds. After that, the balance sheet would start to shrink, gradually, as the Fed sold off all the assets it bought, falling to under $2 trillion by 2019. In reality, the value of assets in the Fed account exploded far faster and far more than the Fed expected, hitting $4.20 trillion by 2016. The account remained at that high level, virtually unchanged, until February 2018. In other words, the SOMA account became about twice as large as the Fed expected it to, and it never shrank in the way the Fed had forecast. There was a final, important error in Carpenter's presentation.
It assumed that the rate of price inflation would fall during 2012, but then start to rise again, continuing to rise steadily through 2015. At that point, it would level off and hover around 2%, which happened to be the level the Fed was targeting with its policies. This never happened. The inflation rate lagged below the Fed target of 2% for most of the period between 2012 and 2020. The rate was still 1.9% by December 2019. This last error carried profound consequences. The rate of price inflation was basically the only external brake that could be applied to the ZIRP policies.
If consumer prices started to rise, then external pressure would build for the Fed to raise interest rates and undo quantitative easing. But if that didn't happen, the Fed would keep interest rates at zero and keep buying bonds. Even as Carpenter walked through his presentation, he peppered his commentary with caveats and warnings. He tried to explain that the forecasts were merely educated guesses. The forecast was based on theoretical models, and those models were based on certain assumptions about the way the world worked. But there is layering, model upon model, to try to get these effects, he said after the presentation. When asked about the presentation, years later, Seth Carpenter was almost sheepish about it. "I certainly get mocked for it," he said with a laugh. The reasons for the Fed's errors were systemic, and they illuminated how the Fed used its unrivaled research capacity. When trying to figure out the future, Carpenter relied on a macroeconomic model called the FRB-US model.
That model assumed that economic conditions would, over time, revert to the historically normal state. Interest rates, inflation, and unemployment would all tend to go back to the levels where they had been over the previous decade. The shortcoming of most macro models is that the vast majority of them make the assumption that over time conditions will revert to a prevailing norm, Carpenter said.
When taken together, the mistakes made it seem as if a new round of QE would be an emergency action that would quickly boost growth and create jobs, and which could then be repealed so everything could return to normal. If that was true, then quantitative easing would be a tool like others used by the Fed, like interest rate cuts, that could be imposed and then quickly withdrawn as conditions changed. The truth turned out to be the opposite. The distortions from quantitative easing were deep and long lasting, and the program, once employed, was essentially never ending. These forecasting errors were not an isolated incident. Central banks around the world consistently misled themselves about the effects of quantitative easing. The banks overestimated QE's positive impact on overall economic output, when compared against studies conducted by outside researchers, according to a 2020 study by the National Bureau of Economic Research. And central bank researchers who reported larger effects from quantitative easing tended to advance faster in their careers, the study found.
This could have been due to the fact that the researchers reported to the very central bank leaders who were pushing for the programs. The forecast helped Bernanke make the argument that the FOMC was only making a limited and flexible commitment. But other committee members were still strikingly critical of the plan. Dennis Lockhart, president of the Atlanta Fed, was clearly torn about it. "I have some reservations about going down the path of a new QE," he said. "This time around it seems to me that we face a more conventional problem of inadequate demand, and I am not convinced that lowering general market rates will stimulate much credit expansion and spending." Sandra Pianalto, president of the Cleveland Fed, said that another round of quantitative easing would not help as much as the earlier rounds, and that it would be hard to end once it started. These arguments were tame compared to the arguments of the non-voting members like Richard Fisher and Esther George, who had replaced Tom Hoenig as the president of the Kansas City Fed. They argued that the plan would be ineffective, that exiting it would be difficult, and that the Fed was building up longer-term risks that were difficult to measure let alone mitigate. Bernanke's answer to these concerns was the same as it had been since the financial crisis. The Fed had to have the courage to act. Congress was clearly sitting on the sidelines. Growth was slow. The benefit of quantitative easing might be small, but if the Fed had the power to gain even small advantages, then it had an obligation to do so. "We want to persuade our colleagues, and that's certainly laudable," he said. "But the fact is that nobody really knows precisely what is holding back the economy, what the correct responses are, or how our tools will work." Bernanke admitted that another round of quantitative easing was essentially a shot in the proverbial dark. But he believed there were risks to not taking the shot. And, just as important, they all needed to support his shot in the dark once it was made. "I think, really, it's going to be very important for us to pull together, in a sense, to support whatever efforts that we make," he said. The vote that day was a familiar one. In spite of their concerns, 11 of the FOMC members voted for the plan. Only one voted against it. The single dissenting vote, this time, came from Jeffrey Lacker, the Richmond Fed president. Lacker's dissent didn't really matter. It could be explained away as the stubborn action of a cranky regional bank president. What did matter was the fact that Fed governors like Betsy Duke and Jay Powell supported the plan. Duke had been won over because Option B was crafted in a way that gave the Fed flexibility.
The option didn't set an end date or a specific amount of bond purchases, which gave the FOMC the freedom to either intensify the program or reduce it, depending on the state of the economy.
"I genuinely believed that it was a temporary program and that our balance sheet would go back to normal," she later recalled. Almost immediately, she was proven wrong.
When the Fed announced that its QE program would be open-ended, Wall Street investors interpreted the ambiguity as a signal that the Fed was planning to go big.
Within 3 months of launching the plan, the Fed's fundamental mistake was apparent.
By January, the average dealer on Wall Street expected the Fed to keep purchasing assets through the end of 2013, buying about $1 trillion in securities during the year.
In reality, the Fed was only planning to purchase about $500 billion that year, and planned to make the purchases only through June. This was particularly frustrating for Betsy Duke. She had voted for the program only because she believed that it would be limited. Now the market was expecting something far bigger. "We got comfortable with a $500 billion program, but nobody in the markets ever knew it was a $500 billion program. It immediately went to $1 trillion, $1.1 trillion, Duke recalled later. If the Fed stuck with its original plan, it would be a disappointment, and markets might fall. This imposed a choice on the FOMC. The committee could either expand the program or tell the investors that they were mistaken. It's either going to be, we end up with a program we never intended, because we don't want to disappoint markets, or markets end up disappointed at the size of the program.
One of those was going to happen, Duke said. She knew that some members of the FOMC, such as Janet Yellen, would be fine with a $1 trillion third round of quantitative easing. But Duke was not. Neither, it became clear, was Jay Powell. During the FOMC's January 2013 meeting, Powell abandoned his tone of moderation. Instead, he delivered a warning about the dangers and distortions of quantitative easing that was blunt, and even horrifying in its way. Powell said that the Fed was potentially creating an asset bubble in the markets for debt like corporate bonds and leveraged loans. And the correction, when it came, could be deeply damaging. Many fixed income securities are now trading well above fundamental value, and the eventual correction could be large and dynamic, he said. The language was restrained, but the message was not. Powell was clearly saying that the Fed might be laying the foundation for another financial crash, or a large and dynamic event, as he put it. This was around the time when Duke and Powell joined together to push back against Bernanke. They were joined by the former Harvard professor Jeremy Stein, who became a Fed governor along with Powell. Duke was particularly impressed with Powell's approach to the problem. After the FOMC meetings, she would reread his comments and think about his critiques. The three governors began to meet and compare notes. They occasionally met for lunch in the Martin Building, an auxiliary Fed building just behind the Eccles Building, which had a cafeteria and private dining rooms. They united around a common goal: to force the Fed to stick with the program it had originally envisioned. This meant that they wanted to start winding down the asset purchases sometime around June. Bernanke knew about this mini-insurrection, and he soon started describing Duke, Powell, and Stein as the three amigos. They posed a political problem for him. If they were to dissent in unison, it could bring an end to the program. During the March meeting, Powell presented the findings from his own personal survey of 75 investment managers. Many worked for exactly the kinds of institutions that were being pushed by the ZIRP policies to make riskier and riskier investments: pension funds, insurance companies, and endowments. 64% of them said the Fed was incentivizing people to make investments that didn't make sense. 74% were worried that the Fed would not be able to easily exit the quantitative easing program even if it wanted to. 84% said the Fed was inflating the value of assets like corporate junk debt. They generally supported the Fed's efforts to have an accommodative policy, but they doubted the effectiveness of quantitative easing. Powell doubted it as well.
I think we need to regain control of this, he said during the meeting. The Fed was purchasing $85 billion in assets every month. In January 2013, Fed staff had estimated that the new round of QE would ultimately add $750 billion to the bank's balance sheet. But by March, even $750 billion was starting to look like a conservative estimate if the Fed didn't pull back or end the purchases. Bernanke met with Stein and Powell. He continued negotiating with Duke. The three governors were unwavering. They wanted the FOMC to impose discipline on the program and cut back purchases. Stein gave public speeches about the inherent risks of quantitative easing. Both Powell and Duke continued to pressure Bernanke during FOMC meetings. Eventually, Bernanke reached a compromise with the three amigos. After the meeting in June, Bernanke would announce that the Fed might start slowing down its new QE program. The goal was to clearly tell Wall Street traders that the QE program wasn't going to surpass $1 trillion, and it certainly wasn't going to last forever, as some traders seemed to believe. Duke and Powell agreed to this compromise. After the June meeting, Bernanke walked to the press room to deliver the news.
Duke and the other governors often gathered in a conference room in the Eccles Building to watch as his comments were carried live on CNBC. Bernanke was the first Fed chairman to give regularly scheduled press conferences.
He began the practice in April 2011 to help quell the political backlash that followed quantitative easing. After the blowback that greeted our introduction of QE2 in November 2010, we needed to do more than ever to explain our policies clearly and effectively, he later wrote in his memoir. The tactic was remarkably effective.
Carola Binder, the economist who studied media coverage of the Fed, found that most outlets never covered FOMC meetings, unless Bernanke held a news conference.
When that happened, the cameras put the focus on Bernanke himself, allowing him to shape the message. In the press room that June, Bernanke stood on a stage under bright lights that had been set up for the benefit of TV cameras. He went directly to a single chair set behind a lectern, where he sat down, opened a folder, and removed some papers that he placed on the lectern in front of him.
Good afternoon, he began, looking up to address several rows of journalists who sat behind rectangular tables arranged in rows extending back to the rear of the room.
The journalists were a well-dressed crowd with deadly serious glowers on their faces.
Most had a laptop open on the table in front of them.
The stories they were already typing, and the questions they asked, were instantly transmitted to eager crowds of financial traders staring at television sets across the world. Bernanke started with a prepared statement, and in the midst of it he said that quantitative easing was essentially temporary. The Fed would likely taper off its purchases if growth remained strong, and would consider ending the program around June 2014. Bernanke soft-pedaled the announcement as much as he could, emphasizing that the Fed would still keep interest rates near zero.
Bernanke's first question came from Steve Leisman, a bulldog of a reporter with CNBC. Leisman zeroed in immediately on the idea that the Fed would be scaling back QE. I hate to use my question to ask you to clarify something, but when you said, gradually reduce purchases, beginning later this year and ending it next year when the unemployment rate hits 7%, what is that?
Is that a decision by the FOMC? Bernanke equivocated. Obviously there's no change in policy involved here. There's simply a clarification, helping people to think about where policy will evolve. Bernanke's language remained vague and open-ended, but even as he was talking, traders on Wall Street were executing orders based on what he said.
They had heard one thing above all else. Quantitative easing would be reduced, and it would probably be reduced sooner rather than later. What happened next was often described as a kind of market shock, or an unforeseen spasm of volatility. But it was, in fact, an entirely measured reaction to the idea that the Fed would slow down QE. This reaction became known as the taper tantrum. The taper tantrum was the first of multiple market shocks that would illustrate the profound fragility that ZIRP and QE had embedded in the financial system. It is helpful to understand this by thinking of the financial system as a seesaw. On one end of the seesaw there are risky investments, like stocks or corporate debt. On the other end of the seesaw there are very safe investments, like 10-year Treasury bonds. Money travels back and forth, from end to end, on the seesaw depending on how bold investors feel.
Since 2010, the Fed had been pushing money away from the safe end of the seesaw, where the 10-year Treasury bills sat. This was the whole point of QE, to force investors to push their money over to the risky end of the seesaw because the Fed was keeping interest rates low on 10-year Treasury bills by purchasing so many of them. 2. When Bernanke indicated that the Fed would be buying fewer 10-year Treasury bills, the money started to move back over to the safe end of the seesaw, and away from the risky assets. This is when the seesaw tips, and it would do so with increasing velocity as the Fed's interventions became more extreme.
The most obvious symptom of the taper tantrum was a sudden decline in stock market values. The Dow Jones Industrial Average fell by 1.35% almost immediately on the chairman's remarks. But the stock market was actually a sideshow. The real danger showed up in the market for 10-year Treasury bills, a bedrock of the global financial system. The interest rates on 10-year Treasuries shot up the day of Bernanke's announcement by 0.126%. That might not sound like much, but in the world of ultrasafe Treasury bills it was a massive and jarring movement. The rate would jump over half a percentage point, from 2.2% the day before Bernanke's press conference to 2.73% within weeks. This movement didn't register as a financial crisis, or even a market crash, for most Americans. But it felt like the beginnings of a crisis inside Wall Street.
Everybody could see what would happen if the money started rushing to the safe side of the seesaw and left the risky investments to survive with less cash. The balance of risk was changing quickly. Rising yields on treasuries meant that Wall Street might have a savings account again, and investors didn't need to keep their money out on the risky side of the yield curve. When this fact was apparent, investors turned around and looked at all the risky junk they'd bought, like leveraged loans and corporate junk bonds. They could now dump those investments and put their money somewhere safer.
This was what started happening in late June and early July.
And it happened in the kinds of arcane markets where the Fed's QE money flowed. Real estate investment trusts, REITs, began force selling their holdings as mortgage rates adjusted. Money fled from corporate bonds, and indebted companies saw their interest rates rise. Even within hours of the press conference, Betsy Duke was watching the taper tantrum play out on the television set in her office. She also had a Bloomberg computer terminal providing real-time financial data. Her heart sank as she watched the Treasury rates spike. It reflected an almost instantaneous wiping out of all the work the Fed had just done. So many billions had been pumped into the banking system to push down Treasury rates, and now the declines were disappearing. At that point, it forced the Fed to be even more committed to continuing on, she said. The continuing of the purchases, there just kind of wasn't any choice at that point. They had to continue, and had to bring reassurance to the market that they were going to continue. The plan to taper was abandoned. The new round of quantitative easing had started as a small commitment in 2012. It was sold as an insurance policy and a contingency plan that could be withdrawn.
In January 2013, an internal FOMC memo described the QE plan as a program that would end in June 2013 and would add $750 billion to the Fed's balance sheet.
Instead, the program continued through September. Then it continued into December. It was only then that the Fed started to even diminish the size of its monthly purchases, and it did not end them. The quantitative easing program continued through June 2014, and then into October 2014. Finally, the Fed stopped making purchases that month. The $750 billion program ended as a $1.60 trillion program. The program's quick withdrawal, which had been forecast in the presentation by Seth Carpenter, never materialized. The Fed would not even attempt to start shrinking its holdings until October 2017, and even then the effort was halting and largely unsuccessful.
Ben Bernanke and the FOMC had fundamentally redrawn the economic landscape and the rules of monetary policy.
Betsy Duke announced in July 2013 that she was leaving the Fed board. Her resignation had nothing to do with the policy disagreements over quantitative easing.
She had been on the job for 5 years, commuting between Washington, D.C., and her home in Virginia Beach. She was ready to move on to new things. At one of her final meetings, in June, she said that she wanted to cast a dissenting vote. The quantitative easing policy had gone on for too long and had grown too large. But she voted along with the majority. The time to oppose it would have been at the beginning, she said. The Fed was locked into the asset purchases and the program was creating new levels of debt across corporate America, while also inflating asset prices. This wasn't an unintended consequence of QE. It was the goal. One of the Fed's own economists, David Reifschneider, clearly explained during an FOMC meeting in 2012 that ZIRP policies boosted growth through 3 channels: cost of capital, wealth effects, and the exchange rate. Translated, this meant that QE made debt cheaper, stoked asset prices, and devalued the dollar, which could boost exports. At the same meeting, economist William English said QE would boost asset prices, and adding more QE would boost them higher.
In March 2013, the Fed economist Nellie Liang told the FOMC that low interest rates were already inflating asset prices, possibly stoking bubbles. This wasn't a forecast based on models, but an assessment based on the Fed's unparalleled market surveillance. But some of the most dire and most prescient warnings came from Jay Powell. While financial conditions are a net positive, there's also reason to be concerned about the growing market distortions created by our continuing asset purchases, Powell had said at the January FOMC meeting. He warned that the Fed was wrong to presume that it could clean up the mess after a bubble burst. In any case, we ought to have a low level of confidence that we can regulate or manage our way around the kind of large, dynamic market event that becomes increasingly likely, thanks to our policy. Powell was concerned about one market in particular, the market for exotic, risky corporate debt. This was the kind of debt that private equity firms and hedge funds used to buy other companies. The debt, sometime in the form of leveraged loans, was packaged and resold, just as home loans had been during the 2000s.
Back then, home loans were packaged into something called a collateralized debt obligation, or CDO. In 2013, corporate debt was being resold as something called a collateralized loan obligation, or CLO. When Powell talked about leveraged loans and buyouts, he was describing his own life experience. He had spent a good part of his career engineering exactly the kinds of risky debt that he was now warning about. As it happened, Powell's experience in the private equity world would become directly intertwined with his experience at the Federal Reserve. The way this worked is that the Fed bought long-term Treasury bills and then simultaneously sold an equal amount of short-term Treasuries into the market. This maneuver was the twist. The Fed was taking long-term bills out of the market, which lowered the interest rate of those bills by increasing demand for them. But the fact that it was selling an equal value of short-term bills ensured that it wasn't increasing the total supply of new cash in the banking system.
Every dollar the Fed added through a long-term T-bill purchase, it took away with a short-term T-bill sale. The goal was to dissuade investors from saving money in a 10-year Treasury bill while not flooding the banking system with cash. 2. Interest rates fall on Treasury bills when the Fed buys them because the Fed is increasing demand for those bills. When demand is high, a borrower has to pay less money in interest to get a loan, hence rates fall. OceanofPDF.com. Chapter 8. The Fixer, 1971 to 2014. When Jay Powell was a senior in high school, his classmates included a future congressman and Panama's future ambassador to the United States.
Other students from Georgetown Preparatory School became U.S. senators, lobbyists, federal judges, and senior corporate executives. 2 future Supreme Court judges, Neil Gorsuch and Brett Kavanaugh, graduated from Georgetown Prep in the mid-1980s. The Georgetown Prep campus was near Powell's childhood home in Chevy Chase, a suburb of Washington. The streets of Chevy Chase were lined with majestic oak trees, and the stately houses were set back behind wide, lush lawns. Powell was one of 6 children in a large Catholic family. He was named after his father, a prominent corporate attorney who had argued in front of the Supreme Court. Powell's mother, Patricia earned her master's degree in liberal arts from George Washington University and was a well-known volunteer around Chevy Chase who also worked part-time for the Republican National Committee. The family belonged to the Chevy Chase Club, along with an exclusive dining establishment in Washington called the Sulgrave Club.
Every morning, during high school, Jay Powell was dropped off at Georgetown Prep's isolated campus, just off the busy Rockville Pike. After entering the campus, a long, winding road took students past a golf course, tennis courts, and a guard shack to the main cluster of academic buildings centered around a grassy quadrangle. It looked like an Ivy League college campus. The curriculum at Georgetown Prep was rigorous, but a lot of the real education happened between classes, and it taught lessons that were impossible to replicate elsewhere.
At Georgetown Prep, a person learned how to be around the most powerful people in the world.
The savvy students would have picked up on a million unspoken cues and subtle rules of etiquette that govern interactions of the very rich and influential. It is difficult to even quantify this code of conduct. A person needs to live it. As an adult, Jay Powell knew how to operate at the center of things. He would spend almost his entire career at a very specific spot at the pinnacle of American power, the intersection of public government and private money. He occupied the offices that connect the worlds of Washington and Wall Street. He was a fixer who helped things operate smoothly between big capital and big government, and he developed a very good reputation in this rarefied world. Powell was a man of discretion and good judgment. He was solid. But he was never a prime mover in the halls of power, never an elected official or a CEO. He was impeccable at his job. While never famous, he was nonetheless deeply respected in the circles that really mattered. It was fitting that when Powell was eventually appointed chairman of the Fed, in 2018, his selection generated almost no controversy. He was seen, above all things, as being an effective operator. In a 2017 interview with the Washington Post, an investment manager named Michael Farr said of Powell, "He's neither a hawk nor dove," using the terms that defined a Fed governor's stance on fighting inflation.
Powell had been a Federal Reserve governor for roughly 5 years at that point, and had engaged in some of the thorniest, most complicated debates about Fed policy. And yet Farr and others saw Powell as a man with no fixed belief system, just a desire to get things done. "He's a pragmatist who will pursue an economic good and turn a deaf ear to politics," Farr said. Powell never turned a deaf ear to politics. His ear was sensitive and his judgment was keen. His career path was the path of a person who listened closely and who learned lessons at every step along the way. He would often be described as a lawyer, because he had earned a law degree. But his career was far more varied than that. After he graduated high school in 1971, Powell enrolled at Princeton. After graduation, he became a legislative staffer on Capitol Hill and then went to law school at Georgetown University, earning his degree and then clerking with a federal appeals court judge in New York.
Powell followed his father's footsteps and became a corporate attorney, joining the firm Davis Polk and Wardwell. In 1984, however, at the age of 31, Powell made a consequential move. He left the world of law and joined the world of investment banking. Powell was hired at a firm called Dillon, Read & Company. This was where he'd begin his long path toward great wealth in the world of corporate debt. When journalists describe Dillon, Read & Company, they almost inevitably use terms like white shoe, elite, and exclusive. The company had been around, in one form or another, since the 1800s.
Partners at Dillon, Read were the relentlessly effective servants of big money. When two big companies wanted to merge, for example, they asked Dillon, Read to handle the details. When a city needed to borrow money by issuing bonds, its politicians asked Dillon, Read to package the debt and sell it to banks. Deals like this generated millions of dollars in fees for the firm's partners. It might seem odd that a lawyer like Powell would join an investment firm. But the transition from corporate law to high finance is common because lawyers can handle the thorny, wildly complicated contracts that make big money deals possible. A background in law trained someone like Jay Powell in a key skill set necessary for success at Dillon, Read: discretion. The corporate culture was very private, recalled Catherine Austin Fitz, a managing director at the firm during Powell's tenure there. The reasons for discretion were strategic. When a publicly traded company started talks to merge with another one, secrecy was key.
If a Dillon, Read partner leaked details of the deal, it might open the door for someone to illegally trade on the inside information. Big companies worked with Dillon, Read because they trusted its partners to stay quiet, maybe for months at a stretch, as they helped negotiate the deal. The other key attribute to success at Dillon, Read was loyalty. The company built long-lasting relationships with its clients that endured years, if not decades. Fitz said that the partners at Dillon, Read were like members of the Hanseatic League, a guild of merchants who operated in Northern Europe during the 1300s. Their tagline was, "Serious business with long-term partners," which is a perfect description of Dillon, Read, Fitz said. They went about their things very quietly. Discretion was everything. And relationships. They really prized long-term relationships. Dillon, Read focused on deals that were profitable, but not flashy. The firm dealt with energy companies, manufacturers, and city infrastructure departments. This was tedious, highly profitable work that required a certain creativity in realms of life that people believed to be lethal to creative minds, like accounting, bond repayment scheduling, and the writing of loan covenants. If a person operated effectively in this space, the payouts were enormous. By all indications, Powell thrived in the environment. Powell would have learned, at Dillon, Read, about the granular mechanics of issuing corporate debt. This form of debt came to play a central role in American economic life during the decade of quantitative easing and ZIRP. When Powell warned, in 2013, that loan values were being inflated and might crash, he was talking about corporate debt.
His warnings reflected his deep knowledge about a corner of the financial world that was once dominated by elite firms like Dillon, Read. Because he helped create and sell corporate debt for so many years, Powell would have understood that the debt was structured in a strange way that eventually made it a profound danger to the global financial system. There are two basic kinds of corporate debt: a corporate bond and a leveraged loan. These things sound complicated, but they're not. A corporate bond is, in many ways, like any typical bank loan. A company might borrow $1 million by issuing a bond, and the bond will carry an interest rate of 5%. The bond has a lifespan, like a 30-year home loan, at the end of which it must all be paid back. But this is where the similarities end. Corporate bonds have a strange structure that's different from credit card debt or a car loan. With a corporate bond, the company only makes interest payments during the lifespan of the loan, and then pays off the entire debt on the day the loan expires.
So the loan doesn't get gradually paid down over the years, like a mortgage. The open secret about corporate bonds is that the companies almost never intend to actually pay them off. Instead, they usually roll the loan, meaning they hire a bank to sell the debt before it comes due and then replace it with a new loan. The bonds expire, but the debt survives and is rolled into a new bond that the company will later sell and roll again. Companies continually roll over corporate debt for years. This is what leaves them exposed to risk. If interest rates are rising when it comes time to roll the loan, companies can be in deep trouble. They face two bad choices. They can pay off the entire debt at one time, or they can roll over the debt into a bond that has a higher interest rate, and is therefore more expensive. In spite of this risk, there is a vigorous market where corporate bonds are bought and sold. The bonds are standardized and regulated by the Securities and Exchange Commission, just like shares of stock. The price of a bond can go up and down, just like a stock. A bond price is usually expressed in terms of how likely the borrower is to repay. A good bond might be trading at 95 cents on the dollar, meaning there is an expectation that the bond will be paid back nearly in full. People buy bonds, even very risky bonds, because it's a great way to make steady money if you can stomach some risk. The interest payments are regular, providing great cash flow for whoever owns the bond. The riskier a bond is, the higher the interest rate it pays to compensate for the danger that the borrower might default. A big, safe borrower like Walmart pays a low rate while smaller companies with a lot of debt pay a high rate. The riskiest corporate bonds are the ones called junk bonds. The other type of corporate debt is called a leveraged loan. This is like a corporate bond in some ways. A leveraged loan is bought and sold, and it carries an interest rate that reflects its risk. The key difference is that leveraged loans are more tailored. They tend to be extended directly from a bank to a company, and they aren't standardized in the same way bonds are. Firms like Dillon, Read used corporate bonds and leveraged loans as rocket fuel to propel corporate takeovers, mergers, and acquisitions. Powell thrived in this business. When he was in his mid-30s, he looked like the kind of guy you would trust to operate a secret multi-million-dollar corporate takeover deal. He had the type of baritone voice that telegraphed confidence and authority, with a narrow face and dimpled chin that blended handsomeness and bland reliability. The only jarring thing about him was the shock of white hair that rose up right at his part, like a stripe.
Powell did well at Dillon, Read, but his education in corporate debt was interrupted before he could earn the kind of fortune that drew corporate lawyers to Wall Street.
In 1988, the company's chairman, Nicholas F. Brady, was recruited by Ronald Reagan to become Secretary of the Treasury. After George H.W. Bush was elected president, and Brady's job security was ensured, Powell left Dillon, Read to join Brady at the Treasury.
There is no more telling sign of Powell's success during his early years in private equity. He clearly had Brady's trust if he went to Treasury, Fitz said. Brady was no fool. Brady's trust in Powell would be validated almost immediately after Powell arrived in Washington, D.C. A scandal erupted inside the Treasury Department involving criminal fraud, risky derivatives contracts, and a too-big-to-fail Wall Street investment house. Powell was called upon to help fix the mess, and it provided him with the next phase of his education in the ways of power in Washington. The problem started inside the large bureaucracy that Powell oversaw. He was Assistant Treasury Secretary for Domestic Finance, a job that put him in charge of issuing the government's debt. His division was the one that actually issued U.S. Treasury bonds. In some ways, the job was mundane and predictable, sort of like running a printing press. The U.S. debt system was well established and well run, so Powell's job was like that of a station manager who had to make sure the trains moved smoothly through a busy station.
His department worked closely with the New York Federal Reserve Bank, which auctioned off the Treasury bills to the primary dealers on Wall Street. In February 1991, the traders at the New York Fed reported something odd. There was a small detail that seemed askew on one of their Treasury bond sales. During one of the auctions, the Fed sold treasuries to two customers, an obscure investment firm called Mercury Asset Management Group and another one called S.G. Warburg Group.
The strange thing was that both companies turned out to be different affiliates of the same investment firm. If these two companies were buying treasury bonds on behalf of their common owner, that would be illegal. The government put strict limits on how many treasury bonds any single company could buy so that nobody could corner the market. The trades looked fishy, raising suspicion that a big bank might be trying to sneak around the limits by purchasing treasury bills through seemingly separate shell companies. The common owner of the firms was the primary dealer Salomon Brothers. A lower-level employee in Powell's department sent a letter to Salomon, asking what was going on. Did Salomon know that these two customers were actually one customer? Inside Salomon Brothers, this letter was quickly conveyed to Paul Moser, the bond trader who oversaw the firm's treasury bill purchases. Moser came clean to his bosses very quickly, admitting that he had been running a scam using affiliate companies to buy enough treasuries that the firm could quietly amass more than the 35% of all the treasury bonds sold in a given auction, the limit imposed by law.
The goal was to get so many treasuries that Salomon could then put the squeeze on other firms that bought the bills in a secondary market. There was no gray area here. It was a criminal scheme. But Moser wasn't fired, and Salomon covered up his behavior. The company sent a letter back to the Treasury Department explaining that the suspicious purchases were an innocent mistake. Moser continued the scheme, cornering the market and squeezing competitors. In May 1991, Salomon used the scam to buy so many treasury bills that it controlled 94% of the supply. The Treasury Department, meanwhile, seemed entirely content with Salomon's explanation that nothing was amiss. Jay Powell's division kept auctioning off treasury bonds through the New York Fed, and Salomon kept gaming the market. Powell's boss, Secretary Nicholas Brady, happened to be good friends with Steve Bell, the managing director of Salomon Brothers' office in Washington, D.C. Bell wasn't a bond trader. He was one of those people who had worked in Washington for years and seemed to know everyone. Bell had become friends with Brady, for example, because Bell was staff director for the U.S. Senate Budget Committee when Brady was appointed briefly to the Senate seat in New Jersey. The two were close, and Bell was a regular guest at Brady's rural estate in Maryland, where the two of them would hunt doves. Bell must have made a great hunting companion. He was whip-smart and profane. One of Bell's greatest achievements, back when he was a Senate staffer, was helping the Reagan administration create a novel legislative maneuver called reconciliation, which allowed the president to pass a budget through the Senate with a bare majority of votes, bypassing the filibuster. Reconciliation was later used to pass Obamacare and the Trump tax cuts, earning Bell a level of notoriety on the Hill, a fact that he advertised decades later with pride. I talked to somebody a couple of days ago and she said, "You're the motherfucker that invented reconciliation, aren't you?" Her exact words, Bell recounted. Bell's Salomon Brothers office was located in the Willard Hotel, just across the street from the Treasury building. This meant that Bell was at ground zero when Salomon's criminal behavior exploded into public view.
Salomon's bid rigging became public after the May 22 auction, when Salomon bought so many treasuries that it controlled 94% of the market.
The conduct was simply too egregious to go unnoticed. This time, regulators from the Securities and Exchange Commission and the Federal Reserve didn't take Salomon's word that nothing was amiss. It quickly became clear that the bid rigging would almost certainly result in criminal charges and massive fines. But even more dangerous for Salomon was the chance that the Department of the Treasury might revoke Salomon's designation as a primary dealer. Without that designation, the firm would go bankrupt. It was an existential threat, Bell said. There was one person who helped ensure that this threat was not realized, Bell believed, and it was Jay Powell.
When the bid rigging was exposed, Salomon's CEO stepped down and was replaced by one of the firm's biggest stakeholders, the Omaha investor Warren Buffett.
Bell and the team at Salomon believed that Buffett's reputation could help save the firm. Buffett immediately admitted that the firm was guilty and prohibited Bell's team from hiring the kind of high-priced DC legal firm that might be able to wage a war against the SEC and the Treasury. Buffett came to Washington, set up shop in Bell's office kitchen, and got on the phone to start negotiating with the Treasury Department over Salomon's survival. The person on the other end of the phone line was Jay Powell, Bell recalled. Buffett delivered a simple message: he would help clean up Salomon, but he needed the Treasury to show forbearance. Buffett said, "I will take on this task, but not if you make it impossible for us to survive," Bell said. Nicholas Brady still suspended Salomon's status as a primary dealer, a death sentence in Bell's eyes.
He believed that if the company was allowed to die, it would take down other Wall Street firms with it, and his message was simple: what if you knock down the biggest tree, and it collapses, and knocks down a lot of other trees in the forest? Bell said. Jay Powell would have understood this argument because of his background on Wall Street. I think he knew that there would be some substantial disruption of global financial markets, given the huge position that Salomon had in derivatives and other instruments, Bell said. And while Bell knew very little about Powell, he knew that Powell's advice would carry enormous weight with Brady, because Brady had hired him. Brady needed his guy. The guy brought to Treasury with him, Bell said. Jay knew markets well. He had been with Brady earlier. He had the trust of the secretary. Warren Buffett called Brady directly to plead Salomon's case, and the Treasury Department soon reversed its decision and reinstated Salomon's designation as a primary dealer. Bell would always credit Jay Powell with the victory, and with keeping Salomon alive. I know that Jay was critical in informing Secretary Brady's decision, Bell said.
The ruling gave Buffett time to pursue his cleanup plan for the company. But the bigger problem that worried powerful members of Congress was the regulatory fiasco that had allowed Salomon to cheat in the first place, and to continue cheating even after its trades first raised suspicion. The House of Representatives held a public hearing on the matter in September. In Washington, such hearings are the equivalent of a ritualistic beating, giving lawmakers a chance to publicly express their fury. It was revealing who the Treasury Department sent to testify. While the SEC had sent its chairman and the New York Fed sent its president, Nick Brady sent Powell to testify on his behalf. Powell was the designated target for incoming fire. He arrived at the hearing wearing a gray suit, white shirt, and gray tie. He spoke in long paragraphs as chilly and rehearsed as a court filing. And he was brutalized by the lawmakers. Press accounts of the hearing used words like assailed and interrogated. But Powell never seemed to get agitated. The Treasury had failed to detect Salomon's scheme and allowed it to continue. But Powell managed to explain everything in such a bloodless way that it seemed to drain the passion of his inquisitors. After the hearings, Powell oversaw the writing of a lengthy report on the scandal, and the role of regulators who enabled it. Ultimately, very little was changed. The Treasury Department amended the way Treasury auctions were conducted, moving to the Dutch auction style, which was seen as harder to game. Moser was convicted and sent to prison. Salomon's CEO, John Gutfreund, was fined $100,000. Powell was promoted. He became Undersecretary of the Treasury at the age of 39. His tenure in that role was cut short, however, when George H.W. Bush lost his re-election bid. Powell wasn't out of work for long. His background at Dillon, Read, combined with his years of service at the Treasury, made Jay Powell an ideal candidate for one of the most rarefied jobs in the world, the one that would make him extraordinarily wealthy. He was hired to become a partner at the Carlyle Group. Leveraging the connections and influence of Washington insiders was the core of the Carlyle Group's extremely successful business strategy. The company was co-founded in 1987 by David Rubenstein, a former staffer to Jimmy Carter, who said the company's location in the nation's capital was what gave it an advantage over the other 250 private equity firms that were in business then, most of them in New York. Carlyle specialized in buying and selling businesses that relied on government spending, and it hired former government officials to help. Carlyle partners included James Baker III, a former Treasury Secretary, and Frank Carlucci, a former Defense Secretary. President Emeritus George H.W. Bush was an advisor to the firm. In 2001 alone, Carlyle hired the former chairman of the Securities and Exchange Commission, the former chairman of the Federal Communications Commission, and the former chief investment officer of the World Bank. These people helped steer deals to Carlyle, and Carlyle helped these people monetize their granular knowledge and personal connections in the industries they once regulated.
The Carlyle Group, like other private equity firms, went out and raised money from wealthy people and institutional investors, like pension funds, that put big chunks of money into a pool of cash that Carlyle would use to buy companies. The basic goal was to invest, improve, and sell those smaller companies. Carlyle typically held on to a company for about 5 years and then sold it, ideally for a profit. Debt was key to this business model. The pool of investment money was always supercharged by leveraged loans and corporate bonds. Carlyle would put up some of its own cash, then borrow much more to fund the deal. Importantly, the debt was loaded onto the company that Carlyle bought. Then that company had to work hard to pay off the loan. It was like being able to buy a house that earned cash and paid off its own mortgage. The key quality for a successful partner at Carlyle was to be connected.
The ideal Carlyle partner had to know the right people in government agencies. They also had to know the right bankers who could arrange and syndicate massive amounts of leverage loans. And they had to know talented people to bring in and help run the companies they bought in order to get them ready, in a matter of years, to sell. Powell joined Carlyle in 1997, when he was in his mid-40s.
His office was on the second floor of Carlyle's headquarters building on Pennsylvania Avenue, not too far from the White House. The Carlyle offices were hardly lavish by the standards of private equity. Wall Street firms often decorated their spaces with hardwood finishes and fine art hanging on the wall. The aesthetic at Carlyle was utilitarian. The company hung prints instead of original paintings, and the partners met in stripped-down conference rooms that could have been found in any law firm or insurance office. "Our offices were so boring and plain that it was a joke," recalled Christopher Ullman, a former Carlyle partner and managing director. The partners kept their focus on the marketplace. And the marketplace returned the favor. A parade of banks came to Carlyle to advertise companies that were for sale. It was the job of people like Powell to sift through the offerings, like flipping through the pages of a catalog, seeking out deals with the most potential.
In 2002, one deal caught his attention. An industrial conglomerate called Rexnord, based in Milwaukee, was looking for a new owner. Rexnord made expensive high-precision equipment that was used in heavy industry, like specialty ball bearings and conveyor belts. The company had been owned by a string of investors since the late 1980s, each one loading the firm with more debt and then handing it off to the next, hoping to reap a profit. Even after this treadmill of debt and resale, the firm remained attractive.
It produced the thing that private equity partners valued above all, a steady cash flow. This meant the company was in a good position to pay down the debt that would be loaded onto it. Powell eventually decided that Rexnord was worth the risk. He put together a team to manage the acquisition, and helped arrange the financing to make it happen. Carlyle would invest $359.50 million of its own money, from its buyout fund. Using this cash as a down payment, Powell helped secure 2 loans, worth a total of $585 million, to pay for the rest of the purchase price. This acquisition would mark the pinnacle of J. Powell's private equity career. It also provided him with a first-hand education in the uses and risks of corporate debt. Rexnord's headquarters were located in an unremarkable 2-story brick building next to a big parking lot in west-central Milwaukee.
Just behind the main office building was one of the company's factories and a tall smokestack that had chain belts stenciled down its side in white lettering, a nod to the company's original name, which dated back to the late 1800s. The name Rexnord was born about 100 years later, after one of many mergers. The facility was surrounded by working-class neighborhoods of modest houses. Tom Jansen started working at Rexnord in the 1980s in the accounting department. After several promotions over many years, he became the chief financial officer, a job title that understated his level of responsibility. Many CFOs are in charge of a company's financial affairs. But Jansen was also in charge of shaping and reshaping the entire firm as it repeatedly changed hands starting in the late 80s. Jansen's work was grueling. At one point he quit, but was lured back within a year or so. There was something exciting about being Rexnord's CFO in a world of private equity. The company had become a case study in the debt-fueled model of American capitalism under private equity. One of the early buyout kings, named Jeffrey Steiner, bought Rexnord with junk bond debt, cut costs of the firm, then sold it off in the mid-1990s in a deal that paid him $6.30 million. Rexnord continued to change hands after that. After one acquisition, the new owners fired the entire management team above Jansen with one decree. He was asked to help rebuild the company, and in doing so became close with the next CEO, named Robert Hitt. In 2002, the various corporate divisions of Rexnord were once again being split up and sold for parts by the firm's latest private equity owner, a company based in London.
Jansen and Hitt created a road show that advertised the virtues of Rexnord as a corporate property.
They hired investment bankers to spread the word among private equity owners, and soon they were making their pitch to a parade of speculators who traveled to Milwaukee. There's a whole variety of people that come to kick the tires. There's bottom feeders, that you can tell right away, Jansen recalled. The bottom feeders wanted to buy Rexnord, strip it down, and sell off the pieces for a quick profit. The bottom feeders made Jay Powell and the team from Carlyle stand out. The Carlyle team was cool, calm, and exuded the kind of confidence that comes from big money. When Jansen got up to give his presentation, he explained that Rexnord's products could be found in just about every factory, oil refinery, and mining operation in the country, even if nobody knew what the company did. You don't know what a Rexnord is. There's no such thing, Jansen liked to joke. But there was real money in Rexnord's product lines of highly engineered conveyor belts and specialized ball bearings that were used in airplanes. It made things that people needed to make the world move, Jansen explained. Rexnord's business model was like the one used by razor blade companies. The razor was cheap, the replacement blades were expensive and very profitable. Rexnord made its real money selling replacement parts when the vitally important conveyor belts broke down or the expensive ball bearings wore out. The company's annual sales were reliable, at about $755 million a year. It earned more than $113 million a year in profit before taxes and interest payments. Jay Powell and his team were sold. To Jansen's surprise, Powell turned the tables and started pitching the Rexnord team on the benefits of being owned by the Carlyle Group. Their pitch was, "We want to help you. We want to help you grow," Jansen recalled. The team from Carlyle promised that they wouldn't micromanage.
Carlyle would place its people on Rexnord's board of directors, where they would steer the company, but they'd give the local management team autonomy.
The deal was closed in September 2002, funded mostly by corporate debt that was loaded onto Rexnord's balance sheet.
Rexnord's debt level instantly jumped from $413 million to $581 million, and its annual interest payments on debt rose from $24 million in 2002 to $45 million in 2004.
Rexnord would pay more money in interest costs than it earned in profit during every full year that Carlyle owned it. The debt put pressure on Rexnord.
In early 2003, Rexnord employees in Milwaukee agreed to take an average pay cut of $3 an hour, along with other concessions, to convince the management team not to move 70 jobs to North Carolina.
The Milwaukee employees were unionized, and so moving those jobs to a non-unionized southern state might have saved Rexnord money. But Jansen said the Carlyle team was sensitive about the headlines such an action might create. They were very, very aware that if cuts had to be made, we had to make them with respect. Treat people with respect. They did not want any bad publicity at all over this stuff, he recalled.
After Powell joined Rexnord's board of directors, he often traveled to Milwaukee to meet with Jansen and the rest of the management team, holding long meetings about the company's strategy, budget, and operations.
They didn't gather for these meetings at Rexnord's actual headquarters near the factory.
Instead, they rented conference rooms at places like the Pfister Hotel, a century-old building downtown, with a 4-story tall atrium lined with marble columns and domed with a glass ceiling. Roughly twice a year, the board gathered for a multi-day strategy session at the Doral Country Club in Miami. The club was later bought by the Trump Organization.
The resort was a good place to think, with spacious patios near the pool and golf course, just outside the sprawling hotel complex that looked like a Southern Gothic mansion. Visitors could rent meeting rooms in the hotel that were encircled with wall-sized windows, looking out onto the rolling greens and palm trees.
This was where the board would strategize about optimizing Rexnord's strategy and increasing its cash flow, boosting profits and paying down debt.
The part about paying down debt was key. This was what made the private equity business something like a self-starting perpetual motion machine.
Rexnord employees were working hard to pay down debt that Carlyle used to buy the company, and as they did so they increased the value of Carlyle's ownership stake by making the debt disappear.
If all went smoothly, Carlyle would be able to sell the firm in a matter of years. Unfortunately, the deal started to go sideways almost immediately. The economy slowed down in 2003 and the weakness killed demand for Rexnord's parts as factories, mines, and refineries cut back on production. Carlyle had nearly $1 billion in cash and debt riding on the deal. Jansen wasn't entirely sure that the bet was going to pay off. And he had to deliver this bad news directly to Powell and the other directors. Jansen was surprised by their reaction. Nobody was pounding their fists on tables. Powell, in particular, just asked a lot of questions. I think Jay was probably the guy that had the most pointed questions. I guess I would classify him as a deep thinker, Jansen said. When Powell was told that Rexnord was starting to founder, he only had one primary question. What's your plan? Jansen and Hitt spent long days in meetings at the Miami resort hashing one out. During their off hours, the board members and executives played golf. Jansen felt that he really got to know Jay Powell on the golf course. Golf can be so frustrating that it pushes people to near hysteria.
A perfectly good shot, right down the middle of the fairway, can be followed immediately, inexplicably, by a shank that sends a ball on a heartbreaking angle out into the long grass.
Powell didn't seem to get cocky when his shots were perfect and didn't get bitter when he shanked it. This sounds like a trivial thing, but it was telling. A person can't fake that kind of behavior for hours at a time. It was just like golfing with a buddy, Jansen recalled. Like many people who worked with Powell, Jansen felt a kinship with him. I don't think he's a Midwesterner, Jansen said. But he seemed like it. Jansen took his cues from Powell, who didn't panic when the market sank.
Rexnord eliminated about 385 jobs, from its workforce of 5,285 employees, to lower costs and help pay the interest costs of $45 million in 2004.
But orders rebounded that year, and with lower overhead, Rexnord's profits jumped. Powell's confidence in the management team had been justified.
But it wasn't enough for Rexnord to simply survive from year to year, boosting its sales and cutting costs. That didn't deliver the kind of profits that Carlyle's general partners sought from their investments. Private equity firms sought double digits, usually after selling a company within 5 years or so. These were hard numbers to achieve by inventing new products or breaking into new markets. The more common tactic was to take on more debt and buy more companies. This loaded more debt onto the existing firm, but instantly added new product lines and customers while providing a quick way to cut costs when the firms were merged. Thomas Hoenig would have described this as a misallocation of resources. When it's easier to borrow money, companies use the debt for mergers or private equity takeovers. These activities benefit the people with access to capital, but they rarely spark innovation, create new jobs, or give pay raises to working people. In early 2005, Rexnord still carried more than $507 million in debt and paid twice as much money on interest costs than it earned in profit.
But Jay Powell and the company's board of directors decided that there was room for Rexnord to borrow more. A corporate takeover target caught their eye. It was another old line manufacturing firm based in Milwaukee, called Falk Corporation. Falk was more than a century old and made industrial components like gear drives and couplings. Rexnord's executive team engineered a deal to borrow $312 million in the form of a leveraged loan, which was loaded onto Rexnord's balance sheet, pushing the company's annual interest payments from $44 million to $62 million. Rexnord's total debt jumped from $507 million to $754 million. Still, this acquisition made Rexnord more attractive to an outside buyer. The company had diversified its product line, expanded its footprint, and still enjoyed a steady flow of cash from operations. It was time for the Carlyle Group to cash out its position. First, Rexnord toyed with the idea of going public and offering shares for sale on Wall Street. But there wasn't strong enough interest and Rexnord didn't follow through. The real opportunity came in the form of another private equity firm, called Apollo Management LP. Apollo wasn't afraid of Rexnord's heavy debt burden, because Apollo believed that Rexnord could borrow even more. It devised a plan to purchase Rexnord just as Carlyle had done, by syndicating new leverage loans and loading them onto Rexnord.
Apollo's ambition on this front was remarkable.
The company raised $1.825 billion, more than twice what Carlyle had paid just 4 years earlier. The payoff to Jay Powell and his team was immense. People at Carlyle would talk about the Rexnord deal years later. It is difficult to determine just how much profit Powell earned from the sale, because Carlyle does not disclose such figures. But Apollo's purchase price was more than $900 million higher than Carlyle's. Under Carlyle's investment rules, 80% of the profits would have gone to the limited partner investors who put up money for the buyouts and 20% to Carlyle. Of the Carlyle money, 45% went to the corporate mothership, as they called it, and 55% would go to Jay Powell's team. Tom Jansen, Rexnord's CFO in Milwaukee, also cashed out with the Apollo deal. He'd been through multiple ownership changes by that point, and figured he would get off the merry-go-round. The Rexnord buyout in 2006 was the kind of deal that changed a person's life. Jay Powell's father had been wealthy by